Most real estate investors get it all wrong when they try to swim upstream into doing bigger commercial real estate deals. They might have substantial equity in their properties or a few $100,000 in cash, and they think that they're ready, but they're not. In this video, I'm going to cover the biggest mistake that I made when I was trying to transition from my small multifamily portfolio into larger commercial deals, with the hopes that you avoid the mistakes that I made during the process. And what was that mistake? All right. I pulled a ton of cash out of properties that I owned and had substantial equity in, thinking that, okay, I'm going to pull cash out and I'm going to take that cash and put down on my first bigger deal. But what ended up happening is I blew my liquidity position, and suddenly I didn't qualify for the next property I wanted to buy because I was out of cash. And during that time, I made no effort to build my OPM or other people's money infrastructure. I thought that I was going to be able to rely on hard money lenders, which I'd borrowed millions of dollars from and paid hundreds of thousands of dollars in interest, to be like my private money lenders for down payments on larger properties. Well, they ended up not being there when I needed it. Okay. I had to use a different framework with it, which I've detailed in other videos that I've done. And even if I had raised the cash from private investors, the bank looked at my $500 bank account and denied me flatly, right? Gut punch moment at that point in time. What I should have done from the start was to liquefy my balance sheet and start talking to investors way sooner. Now, here's the thing about commercial real estate, and it's the biggest problem, but it's also its biggest blessing. It takes a lot of effort calling brokers, walking properties, analyzing properties, making offers that go nowhere seemingly. But when you land your first deal, all that work that felt like a waste, well, it was really depositing, like making hundreds of deposits into the universe that pay off with your second, third, fourth, and fifth deal happening in rapid succession. Because you get to the top of the A list with brokers when you show that you have the ability to close on properties. Words gets out, all those properties that you made offers on, that you got beat out, that end up coming back to market because they fell out of contract. Broker calls you, says, hey, is that offer? I know your offer was $600,000 less than the competing offer, but is that offer still good? And then at that point in time, and this is the same situation I was in, I was like, actually, I'm tapped out. I can't move forward. And that loss of momentum can cost you several millions of dollars worth of opportunity costs. So this strategy I'm going to talk about today is what I teach my clients on positioning, keeping their balance sheet positioned that way and optimizing that balance sheet over time so that they can use their current balance sheet to close on millions upon millions of dollars worth of commercial investment properties, whether they be apartments, industrial properties, retail strip plazas, or office. So if you don't have your infrastructure in place way ahead of time, you will watch life-changing opportunities slip through your fingers. And all those brokers and sellers you built relationships with, they're ready to sell now, but you lost your momentum and your credibility as the go-to buyer who always says yes to the right deal, all right? Then you have complete loss of that momentum, and it takes a long time to build that back to be the go-to person to bring juicy off-market deals to, that where the broker needs a buyer who can perform and will close without question. So the strategy I'm sharing today is going to help you build your endless deal pipeline by being that go-to source with property owners and also brokers, and also establish your endless capital pipeline as well, side by side. You'll be able to get financing from banks, raise 100% of the capital from passive investors, give up little to no equity, and be so ready and scalable that you can take anything down in your buy box. Okay. Now, this is very important because when you are able to keep 100% of the equity in your deals, you do not have to close that many deals to reach big, hairy financial goals like financial freedom or replacing your spouse's income or whatever that may be, right? We're not talking about chump change. We're talking about life-changing deals. So the idea is that for the potency of every single deal you do, by keeping 100% of the equity so that you don't have to be busy, like your old self is a deal junkie, if that's what you are. I'm a recovering deal junkie myself, and a lot of clients in my program are. So we're going to talk right now about balance sheet liquefaction. What does that mean? So if you have high equity properties, gut out the equity or sell them. All right, here's the math that I use to do that that I'm going to cover in a little bit. Because as you request bigger and bigger loans, you get more scrutiny from the banks. All right. So If you don't optimize your liquidity and balance sheet now, then it will never be able to keep up with your growth. All right. So this is my litmus test. We use internally with our company and also our clients that buy in secondary and tertiary markets across the country is an 11% return on equity standard. Okay. ROE is not ROI. ROE is how much your equity pays you in cash flow each year. ROI is a return on invested cash. The tricky thing with ROE, for instance, is that your return on equity will drop over time as you pay down debt and you increase the value of that property, and the cash flow won't be commensurate to keep up with that, right? So when we have assets that perform consistently below 11% return on equity, we make the decision as a company to either refinance those properties, pull cash out of it, stick it on our balance sheet. I'm going to talk about later on in the episode here as to what we do with that cash. We don't invest it in properties because we're always about the mantra of use other people's money always. And here's the other thing too. I get approached by a lot of prospective clients that are planning on doing a 1031 exchange, selling 5 properties and then buying one big, huge property from that. I have been a broker for a long time. I left brokerage about 2 years ago, and I can tell you every single client that I've had over my decade plus experience as a commercial real estate broker that was doing a 1031 exchange ended up having that 1031 gun against their head, that shot clock, and they ended up getting into a bad deal, all right, where their equity was trapped forever. So essentially, they overpaid $200,000 for a property in order to save $26,000 in capital gains tax. It's just not worth it. Plus, when your equity gets trapped into a property, you cannot recapture that equity through a cash out refinance, because the key is to buying properties right so that you can actually cash out refi them and either pay yourself back or your investors back in less than 5 years. Typically, when you have a gun against your head with the 1031 shot clock, you're going to be overpaying for property. You may be able to weather the storm, but your equity might be trapped in there forever or at least 5 years, which is going to substantially slow you down. So you may be thinking, and this is the resistance I face when I'm onboarding clients into the Go Bigger Sooner program is, but Matt, I've got a 5% 30-year loan. If I refinance, I'm trading it for a 7% interest rate. How does that make sense? All right. Well, why are you watching this video? Do you want to stay on the hamster wheel, or do you want to get into the big leagues? All right. Those small investment properties you own, you have to think of them as old news. They're important to you actually getting street credibility, getting some experience, but you're entering a new chapter of your investing career that's going to make you millions upon millions of dollars if you follow this strategy to a T. So here's a slick trick. A lot of my clients actually want to transition out of older assets that they own, or old assets that have been old to them, for instance. And the long-term strategy is to buy or acquire or build a portfolio of larger assets, let's say 3 to 5 multi-million-dollar assets that generate a lot of depreciation expense and also loss pass-throughs that can be used to offset future capital gains that you will incur on selling those older properties. Okay. So this does take patience, but it is a winning strategy that I've used because I have hundreds of thousands of dollars in losses that I use as pretty much like a bank account. So if I have $200,000 in actual accrued losses, they're also called net loss carry forwards, I can harvest that $200,000 loss with older property that I've owned that has a $200,000 gain. So I'm able to satisfy the objective of helping keep my balance sheet liquid and then also not getting killed with capital gains tax. So when you're refinancing your older properties, for instance, I'm always making the recommendation in lieu of this whole long-term strategy to do it with a credit union. Why? Credit unions cannot charge prepayment penalties like a for-profit commercial bank. So when it's time to sell those assets and peel them out of your portfolio, you can spin them off without a hefty prepayment penalty. A lot of commercial banks will charge a 53211 prepayment penalty that resets every 5 years when they have a rate reset. All right. So in year 6, you might get whacked with a 5% prepayment penalty, 5% of the actual loan balance itself. All right. So second strategy in liquefying your balance sheet is that if you own your own home, get a HELOC, get a home equity line of credit. If you already have one, update it. All right. You may have opened up a HELOC 10 years ago. Home values have skyrocketed. You've probably paid down a substantial amount of debt on your home and grown your equity. So that HELOC becomes a flexible credit facility to bolster your liquidity position as well. All right. And then when you're shopping for HELOCs, for instance, shop around. Most credit unions will do up to 80% loan to value, but some will go as high as 100% in second position. So call around, all right? Do your research. Check with your real estate investor community that's local to your market as to who has the best HELOC products that in terms of highest LTV, and you'll get some recommendations out there in terms of contacts you can do. The other reason why this is important to do as well is because in my capital raising framework, when you're out there in the discovery process and spreading the word that you're now going to be doing larger commercial deals, I'm looking to bring your friends, family, and professional contacts along for the ride, is the educational process with them on, hey, you want to invest in real estate? I want to help you do that. A lot of people think of the first time, like they don't think of passively investing. They think of, oh, I'm going to do it myself. And 94% of them never will. And the biggest bottleneck they have preventing them from buying their first investment property, whether it be a single family through 4-family unit or an Airbnb or whatever it may be, is that initial upfront chunk of cash. So we went on this in more detail in other training, but by you opening up a HELOC and having that credit facility for yourself, through lived experience, you can also tell other people how to do it as well. And at some point in time in the future, whether this is for your first bigger deal or your fifth bigger deal, some of them will actually take you up on your advice, open up a HELOC and just let it sit there, right? And they'll never buy an investment property because of the 4 T's, right? The tenants, trash, toilets, and most importantly, time. So here's why liquidity matters, all right? As you go after bigger loans, banks shift focus from the deal and on to you. Early on, if you're buying deals below $2 million, they care more about the deal's cash flow, all right? Less about you, right? They want to make sure, yeah, you're not a deadbeat, you have a decent credit score and that sort of thing, but they usually never care about your income because I haven't made any like reportable income in the past 6 or 7 years because I'm a full-time real estate investor, but they will start scrutinizing on your own balance sheet. So this is why you want to be able to structure yourself on the onset of this whole journey so that when you are scaling and becoming a bigger credit risks or credit exposure with banks, that you're having your balance sheet optimized for that moment when they start looking at your own balance sheet, for instance, okay? So that's why I tell my students is that secure your down payment from private lenders, keep your liquidity intact, and then stay as the sole guarantor. Because if you do not have the liquidity to take down these bigger deals in the future, then the bank is going to look at you and they're going to say, well, listen, Matt, I see this is a $5 million deal. It's going to require $1 million plus in cash. And we see that you have $200,000 that you show on your personal financial statement or $50,000 or whatever. You're going to get to that point where they're going to require you to bring on an additional guarantor, even if you are able to raise 100% of the cash yourself, right? And most investors, passive investors, do not want to be a personal guarantor. They'd rather just get a guaranteed fixed rate of return, believe me, between, in this market, 9 to 10% on their money, rather than investing in your deal that has no guarantees and then possibly being on the hook if the deal goes sideways for the debt that's on the deal. So this keeps your deals cleaner, simpler, and more profitable in the process. This also allows you to avoid unnecessary partnerships. I do not like partnerships that are put together from a position of weakness, right? The fewer people in your deals when you're buying your first several larger deals, the better, right? Why? Because there's more upside for you, there's less complexity, and partnerships on sub $5 million deals can be messy, all right? So here's an example. If you partner on a $1 million deal, the cash flow is $30,000 a year, for instance, and now you're stuck filing a partnership tax return every year that's due on March 15th, okay? This is one thing that like completely blindsided me when I had my first partnership. Nobody told me this was like, yeah, there's actually, you don't have to worry about your own tax return you seem to file extension for. And I file on October 15th of every year on the last day of extension expiration, but you have an additional tax return that's due, right? You have to pay a CPA to return this. You have to keep separate books for that. And that's going to cost you anywhere between $2,500 to $3,500, all right? And that $30,000 cash flow, that's 10% of your profit that's gone, all right? But if you bring in $300,000 from private lenders at 10% interest, you keep the upside. Your investors actually make more money because they don't have to split it with you, right? Because you're guaranteeing them a flat percentage of interest. And there's no partnership tax return. And then there's no sharing any upside, right? I like to say that I help my clients like marry desire for cash flow with desire for upside. All right. So where you, if you're a prospective client, for instance, is you own the upside. So let's say you increase the property's value that you buy this $1 million property to $1.6 million over 5 years. You pay your investors back their $300,000. You add $300,000 to your net worth. You basically create it out of thin air through your hustle. And then in that growing net worth, that's what helps you level up into doing bigger and bigger projects, for instance. So if you're able to do, a value add commercial deal every year over the course of 5 years, you're automatically going to add over $1 million to your net worth in the process. So this is what allows you to scale bigger into the bigger leagues. All right. So next set of advice is guard your liquidity like it's rocket fuel. Show the banks that you've got the down payment and the reserves, raise the capital from private investors. And by keeping your liquidity sacred and using other people's money always, remember, UAPMA is my mantra, use other people's money always, then you can keep recycling that same balance sheet, your current balance sheet, till you take this thing to the moon. So now I'm going to go into how to mitigate the higher interest rates, because this is a common objection in this environment. When interest rates were around, like, let's say 4%, for instance, a few years ago, this wasn't such a resistance when I was going through the onboarding process with clients because, I have to pay maybe a point higher, or maybe they were in older vintage debt, for instance, there was higher interest rate anyways, okay? So when you take this cash out proceeds from your refis, I'm not talking about tapping your home equity line of credit and investing it in this way. I'm talking about those cash out proceeds, for instance. Invest them in low volatility, high yield ETFs. And I have 2 of them that I like a lot that I've been investing in heavily. And what this does is it allows you to actually build that liquidity position and then also be able to offset that higher interest rate payments on your investment properties from trading that 5% interest rate to, like, let's say a 7% interest rate. So I'm going to share my screen real quick with you. I'm going to show you exactly what I'm talking about. Okay, so these are 2 ETFs, or exchange traded funds. These are basically mutual funds that act as a stock. Okay, so they can be traded within a day, right? Converted to cash within a day. The reason why I like ETFs rather than mutual funds is that, yes, they are more liquid. They don't have redemption fees. And then also they're typically lower expense ratio. All right. So an expense ratio is basically how much the fund manager charges you to have your money invested in this fund. Now, this fund here, because of the ETF, is 0.35%. All right. This industry standard for mutual funds and ETFs that are actively managed is more like the 1% range. You get to keep more of your money in the process. And so these are the things I looked at. Now, this is not an endorsement of these 2 ETFs. I'm just telling you that this is what I'm invested in. You do your own research and due diligence. I'm not a financial advisor, so therefore I can tell you whatever the hell I want to tell you, okay? So the expense ratio is low here. If you look at this, the other reason why I like it is because the yield is 7.79%. On this particular ETF, that cash yield is paid out monthly, okay? 7.79% on current yield. That's an annual basis, right? But it's paid out monthly, all right? So and I'm going to go into the math later on as to how I can justify you pulling out money and resetting your debt stack on your current properties at a higher interest rate and how it actually pay for itself while giving you more liquidity in the process. But anyways, I like that. And the other thing I like too is that if you look at beta is a measure of volatility of an individual security, right? So at almost half, right? So a beta of 2, for instance, means that security, when the market goes up 10%, that goes up 20%. When the market goes down 20%, this goes down 40%, okay? So this is half of the market volatility, meaning so if the S&P 500 index goes up 10%, for instance, this will typically go up 5% and vice versa when it goes down, all right? The reason why I like this is because typically when there's a huge market correction is when capital markets are scared and actually real estate opportunities become more abundant. You can take advantage of market sentiment because it will translate over to the real estate market as well. So by having a lower volatility of the securities in portfolio, you can do that. All right, and then here's the other sister ETF. Now, both of these funds' objectives is that their strategy is that they hold positions in their representative indexes, right? So this one here, the Equity Premium Income Fund, will have their portfolio in S&P 500 companies, okay? And then this one right here is in NASDAQ 100 companies. And how they actually generate income is that they sell what's called covered calls to options traders, which these can be individual options traders like retail traders or hedge funds that will buy the right to buy, like, let's say, Apple stock at a certain price. And then if the stock goes up to that amount, then this fund is required to sell that according to the contract price. All right. So the selling of these covered calls, actually, these options traders will pay for those options contracts, right? Those options premiums. And then also the fund will essentially have to sell securities as they go up in value, right, to those strike prices. So this kind of mutes the upside and then also mutes the downside because it generates income. So therefore you have this cash generating ability through the selling the options contracts and also the fact that they sell stocks that rise in value quite a bit, right? So with this one that's based upon the NASDAQ, its yield is around 11%, which is pretty killer. And this is also paid out monthly as well. I am invested in this ETF as well, pretty heavily. And I'm going to go into what strategy specifically I use and how I do this, and which actual brokerage house is the most cost effective where I place my investments, and also a killer growth strategy that not many people use, which will allow you to not only establish liquidity, but also establish a very low interest rate credit facility that will allow you to use that credit facility to grow your business, called the securities-based line of credit, but more on that later. So now I'm going to make it make sense for you and make the math on why trading up to higher interest rates to bolster your liquidity position will make sense from a cash flow situation right now. So essentially those higher interest rates, you can actually cancel those out. I'm going to demonstrate, if you follow this investment strategy sidecar to your scaling strategy into commercial real estate, how you can make this actually and neutralize those higher interest rates. All right. So example math. So you've got $400,000 in debt on $1 million worth of rentals, right? So you have a $600,000 worth of equity, and you're currently paying 5% interest on a 25-year loan, for instance, or 25-year amortization. So your payment is $28,000 a year. And let's say you pull $300,000 in cash and lever up those properties, strap them up with more debt, and you refi, you put $700,000 worth of debt on those properties at 7% on a 25-year amortization. The new payment will be $59,000 a year as opposed to $28,000 a year. All right. So the difference is $31,000, which is not an insignificant amount of money. But let's say you take that $300,000 and invest it in an ETF like JEPQ or JP Morgan Equity Premium NASDAQ fund at 11%. That's $33,000 a year in income. So boom, you've just offset the higher payment that you traded up for. Okay. And bonus, by the way, like I said, these properties are old news, all right? But this works really well. For instance, I have clients that rely on the income from their rental portfolio. So sometimes gutting out the equity and making a higher payment, that sort of thing, can significantly reduce their amount of their take-home income. So this strategy works perfectly for those individuals as well. So the bonus on all this whole thing, right, is that if you don't have one already, open up a brokerage account. And I'm not talking about a retirement account. I'm talking about a standard brokerage account. And you can open up what's called a securities-based line of credit. All right. So I am a customer of Fidelity Investments. I did a ton of research on what the best brokers are. Fidelity has a zero-cost trading platform. So you can buy and sell ETFs, for instance, with no commissions or no trading fees and that sort of thing. All right. So that's an additional bonus. They're low cost. Fidelity's they're the cornerstone. They're in the camp of Vanguard and also Charles Schwab, for instance, in terms of being low cost. And then Fidelity by far has the best securities-based line of credit. And a securities-based line of credit, or SBLOC, is like a HELOC on your marketable securities. And you can set up one of these SBLOCs for up to 70 to 75% loan to value on there. So on that $1 million you put in there, you can get a line of credit facility for $700,000 that acts exactly like a checking account. The advantage is that if you have to tap into that into that cash in the future, which I'm going to go in further down in this video as to scenarios you might want to do that as you're scaling, that you do not have to sell stocks and incur painful capital gains tax as a result of that. And the reason why I like Fidelity is that they have a decently high LTV. And then Their interest rate right now is around 6.25%. And the reason why, and that's actually much higher than usual, these S block rates are based upon as interest rates come down, for instance, short-term rates, which is what SOFR is based upon, then that spread will get even more. Okay. And this is what I use for earnest money deposits, appraisals, environmental reports. And this allows me to lock up properties, get it through due diligence, raise the capital from my private investors, and then be reimbursed those costs for the earnest money deposit and also the third-party reports at closing. All right, so then I can keep using this credit facility over and over again. And believe me, you want to have this thing set up, because I just had a client the other day that they put an offer for a property for $1.1 million and a $10,000 earnest money deposit. It was a competitive offer situation. And the broker came back and said, we wanted a $50,000 earnest money deposit. So having that credit facility in place is going to offer you flexibility to get properties under contract and then do everything you need to do from a financial standpoint to put the deals together, which is what I help my clients with. So this is the final takeaway. This strategy will let you buy your first several larger deals at light speed. Because remember, after you buy that first deal, you're going to have your balance sheet set up in a way and also your OPM infrastructure built in a way that you'll never have to say no on a life-changing deal. So you can be the go-to person. Brokers are lazy, all right? So, and they don't keep a CRM system that reminds them when they sign a listing agreement with a client that, oh yeah, let's blast this out to everybody. They're going to go to you next. And this is an incredibly powerful position to be in. And that person that buys all of these types of property types and that you are a closer, right? And this will allow you to replace your income from your job much faster. And then when you're refinancing the properties every 5 to 7 years after you've paid back your investors and stacking $1 million property per year, that will change your life and create and make you a multimillionaire in the process. All right. So that being said, I hope you got value out of this. Remember, this is all important stuff that I wish I would have known early on. And this is what I teach my clients and have them do to enable themselves to grow without any boundaries. And so if you got value out of this, please let me know what you think below. Give me a like, give me a comment, give me a subscribe. What I do for a living as an advisor or a coach, whatever you want to call me with my clients, is I help them go from residential deals to doing larger commercial deals. And the reason why I put this free content out there is because most of you people watching this are never going to hire me as your advisor or coach, all right? So at the very least, I want to be able to give clarity and direction and no BS approach to help people go out there and live life by their own design. So I'll see you in the next video.